I'm John Gatewood, founder and CEO of Gatewood Wealth Solutions, where we are on a mission to help individuals and families become and remain financially self-reliant. Welcome back to our Market Insight broadcast, and Aaron Tuttle, our Chief Investment Officer. Welcome back, Aaron.
John, I'm glad to be here.
You know, it's always good to have you, and we're going to have an interesting conversation today because we're going to talk about debt. We've been talking about that a lot.
Debt and inflation, right?
And inflation. Is debt good or is debt bad? Or is there good debt and bad debt?
Well, I don't know what we have, maybe.
Well, but I wanted to go over two quick things. I was
Oh, so you're not tweeting? I thought you were tweeting.
I had this, but I can remind myself. Now, what is it I'm going to ask Aaron about? But I was reading the Wall Street Journal this morning, and I saw two headlines that kind of captured my attention. And the first one goes, "Banks to companies, no more deposits, please." Can you comment on that?
So yeah, there is a glut of deposits and trying to figure out where it would go, especially with a thing called reverse repo, where the Fed buys it. Basically, they are trying to earn money on their deposits, and you need some type of security to earn, because cash just sitting there, you can go put it in your safe, right? It doesn't have interest that accumulates, it's just loaning it out. And there is some issues with the amount of collateral available, where basically treasury securities, versus the amount of money in the system, and it's trying to find a home. Now, I don't want to point out that one solution would be more government spending to create treasury securities, because I don't think that's the appropriate solution.
But I think that what's interesting is that we've been talking about how much money there is in the system,
yes,
right? Because of all this monetary and fiscal policy. Well, this is just one example of an effect. I mean, companies have so much money that the banks don't even want to hold it.
Right.
Right, because if they hold it and they can't lend it out, then they don't make any money.
Right.
So let's move into today's discussion,
Sure,
because this is a follow-on on our conversations that we've had with regards to the amount of U.S. debt.
So this, I want to give a shout out to Steve, one of our long-term listeners, because it really has been influenced by a question that he asked about the difference between consumption and investment regarding debt. Now, his question was more geared towards the government, but we're going to talk about it more broadly. But it really is coming from there. And also, since we're talking about long-term listeners, I wanted to give a shout out to John and Catherine, because we got to see them over the weekend, and they had mentioned that they are also listening in. So shout out to all three of them. So on debt, really, what is debt? And it's an exchange for present goods now versus future goods later. So if we have $1,000, you're going to have to pay $1,000 plus interest later, meaning that whatever you borrow today, the payment due will always be higher in the future.
Okay.
Now, whenever you receive something, you can either do it as consumption debt or investment debt. Now,
meaning that you borrowed that $1,000,
so
let's say you're going to pay back at a higher
I'm going to borrow $1,000 from John Gatewood,
mm-hmm.
And I'm going to make a decision. Do I use it to consume with, or do I use it to invest with? If I do consumption, I'm going to buy present goods, or whatever it is out there that I desire. Mm-hmm. Maybe I hire somebody to do some work for me. Or I could even say, you know what, I just need some extra cash in my account. The banks don't want to take deposits, but I surely want to make them. And I want to have a balance there. So I'm going to borrow and I'm going to consume. Right? Where if I'm going to do an investment, I also am going to buy present goods. Maybe I believe that real estate is going to go up in value, and I want to buy that, but I have an expectation that it's going to be worth something more. Or I may be hiring labor because I want them to do something through a manufacturing process, and I have something that they're going to produce that I can sell for a higher value later. Or even it's that I'm going to borrow from you because you're going to charge me nothing in interest, maybe 1%, but I can loan out to a friend at 3 or 4%, so I can get that arbitrage. But the expectation for borrowing from investment is that the value of the investment is going to appreciate over time, where if I'm borrowing to consume, I have no expectation of anything being there in the future.
So if I'm borrowing to consume, let's say I take that $1,000 to go on vacation, the money's gone.
Yes.
if I borrow and then I go buy a piece of real estate, my hope is that when I sell that piece of real estate, I'll have more money than what I owe back
Yes.
to the bank or whoever I borrowed the money from.
Yes, correct. So that in the future, whenever that payment is due, if it was consumption, you have to reduce or surrender your consumption later to pay back. And remember that surrender is going to be higher than what you received. So I have to either surrender present goods that I could purchase, or I have to work longer, so I have to surrender some of my leisure time, or maybe I kept that money in my account and I have to give that plus the interest over. So my consumption will be reduced in the future if it's a consumption loan, because I have to reduce my consumption to pay it, and we know that there was interest, so the balance due is always higher than what you consumed on. Now if I did it as an investment and the investment worked out, I could surrender that investment. So let's say the real estate property, and if it appreciated in more value than what your interest was, then I actually have excess. So whenever I make an investment, or when I borrow for an investment, my future consumption may actually go up because I would have more money to consume with. Where if I do a consumption loan, then my consumption must go down and below what I was able to loan.
How does this translate then into government debt?
We're going to get there, but the main thing that I want to point is that with consumption borrowing, your future consumption is reduced.
Okay.
And with investment borrowing, your investment, if it's profitable, your future consumption is actually increased.
Okay.
So getting with the government or moving towards that direction, think of this as like a pension system. Because if you are in a pension system, and let's use a 401k, I think it makes the example more appropriate and less complex, and it's also one that we're probably more familiar with now, is that you have a pension system, you defer consumption now, meaning you take a reduction in what you could consume because there's a reduction in your current pay. So I make a contribution to my 401k, that means my take-home amount is not
It's going to be
lower,
less.
Right, is going to be less. But even if you were on an old traditional pension system, when you took the job offer, you probably realized you were taking a lower current salary with the promise of a future salary in retirement. So either way, there's going to be a reduction in your current pay. And that reduction in current pay, that is going to be used to purchase investments. So for 401k, stocks and bonds. Even if it was a traditional pension, they're going to be buying stocks and bonds if they're funding the pension. But if they're not funding the pension, then essentially you're making a loan to the company. And depending on how it's structured, that loan is either a stock in the company or an IOU to the company that they're going to later pay. And eventually it will be paid out to those future participants as future income to meet their future consumption, which, as long as everything goes as planned, you would be able to have more consumption because you've grown the assets relative to what you deferred.
Makes sense.
Now let's take Social Security, the way that the government is structuring a pension-like system, where really it's not, it's a transfer payment scheme. And I don't mean scheme is like a bad thing, it's just a transfer payment scheme. And what it is you're going to still see your deferred consumption, right? Because you're going to still see a reduction in your take-home pay. We all see the FICA tax,
It's
the payroll
the
tax.
FICA tax that we're paying.
Yes, whether employee or employer, that all will come out of your current pay. And that is transferred to a current participant. And that current participant will then receive that as income. And maybe there's an excess amount of transfer payments, but usually that means the government is going to borrow, and they're going to borrow from that and then spend it out and consume it on the behalf. So what is absent there is an investment. So essentially these are consumption loans whenever we're doing this. And we talked about this last week on
Yes.
these now showing up on the balance sheet. But it does have a long-term impact. So if we look here, and I'm going to go over the slides because it's not as intuitive as we would like to make them, but as the best we can get, is that the blue countries represent a low debt to GDP, or think about it, low debt burden to your production capacity or production ability within the economy. And the red represents countries that have high debt loads, where it's 90% of their production ability. And we can see whether developed, emerging, or developing economies, the production or the growth of their economy is slowed if you have a higher debt load. So developed economies, if you're 30% or less of your GDP owed as debt, you're going to grow at on average 2.6% in the data set, where those that had higher debt burdens were at 1.7%. So we can see that higher debt loads will offset production. And if to kind of look at it a little bit differently, is the relationship of the amount that you're investing relative to your production capacity. So you have to make these interest payments, and if your debt load is high, especially for consumption, you don't have the production capacity built out to continue servicing them. So that means you have less money left over to invest in your future production capacity. So we can see, same thing, high debt loads means lower investment relative to GDP. So we're seeing that. And then ultimately, it's going to show up in production per worker. So one of the things that I think is often lost in the media is that what drives the income to workers is not minimum wage laws. It's not people feeling good and wanting to get, it's ultimately how much can a worker produce, because if they produce more, their standard of living, whenever they trade with everyone else, they have more to trade, so then they will receive more. That is what is actually driving incomes up for the average worker. So if we're not investing in capital to make workers more productive, we're going to see that show up in the production per worker over time. Once again, countries with high debt loads are going to have less productive workers going forward. So then we're seeing an effect on the amount of debt across the world. The U.S. certainly has problems, but it's not just the United States. It's across the globe. So we can see the amount of public debt relative to tax revenue has increased, and it's
so. Let me just make, so if you have Asia, for example, the 483%, the public debt is 483% of tax revenue. Is that what that's saying?
Correct. That is what it's saying. And in Latin America, 472%. In Europe, 372%. In Africa, 289. And if we just look at the world, 2021, 312.
That's why we talk about this being a global phenomenon, just not just an issue of the United States. Everybody's bought into this modern monetary theory.
And really, if we go back to the Great Recession, and we go down to what now is being called the Great Lockdown, there really was a sea change of thinking. So the amount of debt that the world has been putting on has been accelerating. And we can see that here, where we look at the different regions and look at the amount of debt that they had just prior to the Great Recession. So that's the blue, 2007, as a percentage. And then where they were just prior to the Great Lockdown, so in 2020. So let's go with Eurozone. It had 68% versus going into the lockdown at 84%. Now we have advanced economies over there. We're going to break that out on G7. So we can see Japan going into the Great Recession already had 176, and then going into the Great Lockdown had moved up to 235%. The United States, if we go back and we look at the advanced economies, they were going into the recession on average 73%, going into the Great Lockdown 104. You can see the United States was actually below average going into the Great Recession. And now it going into the Great Lockdown had hit average. So it was growing at a faster rate than other economies before. Only Germany, who historically in the modern era went through a hyperinflationary environment, they're the only country where this is not the case, where we don't see it. And what had happened during 2007 is we printed a lot of money, we monetized a lot, and we stimulated, and we didn't see inflation show up. And this is, we've talked about modern monetary theory. And once we got into another one, the amount of stimulus and the amount of spending has grown dramatically through this, even though that I think you can make the argument that the lockdown was not as economically devastating as the Great Recession. Yet the amount of spending has increased because we're not at 104%. Now on the other side, we're at 100 and I think it's 138% is what we talked about last week.
Yes.
So it's pervasive across the system. And it's because we're consuming, because our revenues, our tax revenues off of GDP is not growing near the pace as our debt, meaning that we're not investing in productive capacity, we're doing consumption. And that Social Security is one of them, but it's not to beat up on Social Security. Think of stimulus checks. When you're sending money out to individuals to consume, there's no investment. And remember, our rule is that if you consume now, you have to give up more consumption later. Now, the way that they're going to try to resolve this is, it's not that you'll consume less intangible goods, it's just the price will go up. So you get to pay back with cheaper dollars.
So talk about this slide and what this means.
This is another one that's a little hard to wrap your mind around at first. So what we're looking at is different time periods in 50-year blocks going back to 1800. And then the countries that are represented by blue are countries that are in good standing. They have no financial issues making their debt payments. And then the countries that are in dire straits with their finances. And then we're looking at it, their measure is the amount of inflation in the system. So in 1800 to 1850, if you're the sovereign that you were under was having problems meeting their debt obligations, we actually saw a reduction in inflation because they couldn't print it. It was a metallic system. There was gold coins. 1850 to 1900, we do start to see that. We do start to get some experiment with paper money. You can go to the Civil War experience here where we had greenbacks and the Confederate we had graybacks, so there was some type of paper money. But then we get into 1900 where we have central banks across the world, and we start to see, well, the solution that countries are going to is an inflationary solution, because those that are having problems are inflating. So the average inflation for countries that were struggling was 7.8% between 1900 and 1950. But inflation is showing up everywhere, even in the countries without having any problem meeting their obligations, there was inflation. So we have hard money versus a paper money system. And then we can see 1950 to 2000. Now, for sure, the U.S. was in the 5.6% during that time period. You're going to see countries like Argentina, a lot of the Latin American countries where they get in trouble and eventually they're going to inflate, and eventually they start to tie their currency to the U.S. dollar to try to stabilize it. But we can see that the solution under a central banking system is not default. We're going to see those debts repaid. It's what they're going to be repaid with, and that is dollars that are worth less than they were when they were borrowed. So
People
that
always wonder, are we going to go back to the late 70s, early 80s inflationary high interest rates?
So high interest rates, I don't think we're going to see high interest rates for quite some time, because the Federal Reserve is currently using their ability to create money to keep prices on bonds where they have low interest rates. And the point is they're trying to get inflation to show up in the products so that GDP can grow, at least on an inflationary basis, whether on a real basis or not, so that the debt load becomes lower because prices of things just go up. So that is the solution that they are seeking.
Well, even if we have a 5.6% inflation rate, that's a high rate relative to where we've been the last 10 years.
What we're not doing is saying that these are representative of the inflation that we're going to experience. There are a lot of things that are unique to the 70s that we don't see here. The amount of goods that we offer, because remember, it's inflation, whenever we see it as a price inflation, is too much money chasing too few goods. Well, we certainly have far more goods that we are producing now to kind of spread that out over. There was also energy shocks in the 70s. There was a complete removal of gold from the US dollar, which backed everyone else on a par value, where that was a psychological decoupling that isn't there in the system now. So what we're not doing is saying that we know what inflation's going to be. We're just saying that we see what the central banks are going to do, and that is they're going to try to inflate their way out of it. And it's really all about relativeness. How much inflation do we have versus the interest that on these bonds that we're paying? So long as inflation is over the interest earned on the bonds, you're going to see that slowly deteriorate as a number relative to the broader economy or the production.
Well, we also have the deflationary pressures that we've talked about in the past,
Yeah,
especially technology.
Absolutely. So there are so history doesn't repeat, but it often rhymes. So we don't know what it's going to look like, but we do have an idea of what is being what the powers that be are trying to achieve. And we can see that it's, once again, not the U.S. This is pervasive across the globe. So Japan is the highest at 257. The U.S. At the time of this was 133% of debt to GDP. And you do have some European countries like Denmark, Norway, and Sweden that are relatively low. But as in an economy that could take the flow of capital into it, they're not going to be large enough. And there are certainly countries in Europe that have very, very high debt to GDP levels. They're usually the countries that are down on, they call it Club Med. So northern European countries tend to have good GDP, debt to GDP ratio, and then the ones that are on the Mediterranean tend to have more. And it's nice to be at the beach, so why not?
Yes,
right?
exactly.
That's consumption, right? So we once again are just pointing out that we're in an inflationary system. We are not making a call on what that inflation will be, but that is the solution that central banks are going to use. And we have been consuming or making consumption loans with our government, not production loans. So an example is if instead of sending stimulus checks, we were to go out and spend money on infrastructure and enhance the roads so that we can travel faster or less energy or whatever. Those things can pay for themselves if they're good investments. It's really difficult to say beforehand whether they are not or are. That's the point of the entrepreneur in the system, is to see how to gain value, and it's not an easy process. So hopefully if we do get some infrastructure spending, it's spent wisely and we get a nice effect of it. We certainly did get a great boom to the economy when we did the interstate system. So that's an example of an investment that paid off quite handsomely.
What are some takeaways that we would have from this for the investment committee and client portfolios?
So the takeaway is that we continue to see inflation risk as being high, not certain, the deflationary tendencies, but at this moment, whenever we see the PCE, the CPI, the PPI, that is coming in, and we don't think it's transitory, because we have a client, he had to raise the cost of his ribs in the restaurant by $6 and just pass that on. Now he's also looking at an $18 an hour hire just to get people to come in. So that means he's going to have to raise prices elsewhere beyond just an individual, and that's going to be affected elsewhere, and it's sending out like a chain reaction that's probably got to go through a couple of cycles for our economy before we start really stabilizing and having consistent structure. So we don't think this is a one and done type of effect. We think it's going to process, but we also don't think it's going to be 3, 4, or 8 quarters out.
You and I were talking a little earlier this week even about the cyber attacks and how that could also create problems for
not could, is.
Well, it is creating
right.
problems for the supply chain, and we don't see these attacks stopping, and that this could be a continual effect that is going to, again, put pressure on prices if we can't have a good supply chain.
Yes. But that's not necessarily a monetary problem, that's a supply-demand problem.
Yes.
So then whenever market continues to climb that wall of worry, and we haven't hit new highs, but I wouldn't be surprised if we pass that through. But we have a 50-day moving average of 4150. We would likely buy anything that hit that. And then obviously if we got down to the 200-day moving average at 37.89, we would consider that very bullish. We don't think it's likely, but you never know. There's always black swans out there.
Well, we do hear about slowdown in 2022 or 2023. How would we see that in terms of the movement of the market in those years?
So with inflation getting priced in right now, and we've seen this in taxable accounts especially, value has been favored because inflation, they tend to be able to push their cost out, and the way that the discounted cash flow math works, it favors earnings closer rather than far away. If we were to see that, we would expect growth to move back up, and we ultimately do expect growth to move back up, which is a good lead in here. So small cap, mid cap continue to be doing well. With tax sensitive, we continue to try to make changes and reduce the amount of growth and have favored mid cap and small cap. Last week was a value rotation. Friday was a nice bump though in the growth sector, and that growth has continued to move on. And we are kind of growth all the way down to small value. And that has actually helped both tactical mutual fund and tax sensitive. So at the moment, we are fairly well positioned for both of those to do well in the current environment. The reason we haven't made a lot of changes to tax sensitive, and we hope to have a market insight call, and I'm going to kind of lead into that here in a minute, is because we don't want to realize a lot of the gains in our growth positions to put on value position for 2 or 3 quarters, to have to unwind it again, realize additional gains, and if we want to do it in a timely manner, probably short-term gains, just to go back into growth position. So we're trying to make tweaks on the edges that are not a lot of, does not create a lot of tax liability, and that we can unwind. So I think that ends our presentation.
For today. Very good. Well, we certainly appreciate the insight that you've given us on the debt, because this is it's helping our listeners to understand why inflation is here, it's here to stay, how that's a solution to the government debt over time. It does mean that there's going to be pain, right? Because inflation ultimately is a form of tax, so to speak,
yes,
to everyone who is in the economic system.
When you inflate, whether we see CPI go up or not, what we're doing is transferring purchasing power from people that are not getting the money first to people that are getting the money first. So whether we see a rise in prices or not, you are transferring purchasing power to other people through inflation. Oftentimes that's the government or large corporations that are able to get the money first.
So thanks again for joining us today for our Market Insight broadcast. And our goal, as always, is to give you our data-driven view of the market and the economy, applying our economic theory, so that you can be better informed about your own portfolios and when making decisions about your money. So if somebody wants to invite a friend to join our future calls, what should they do?
Well, make sure you click down below on that arrow and send it over to your friend. And if you're not subscribed, make sure that you subscribe. If you enjoyed this talk, please hit that like button and feel free to leave comments as well. And let us know. Give us some more shout outs on some topics that you would love to cover or like to see some coverage on, and we're happy to see if we can do that.
Thanks again for joining us again today, and we look forward to having you back next week.